Why most investors are doomed to miss major market turns. I'm Bob Stokes with Elliott Wave International. The reason why most investors miss key turns in financial markets is that they linearly extrapolate a trend into the future. If a market is going down, these investors expect that market to continue to go down. And if it's going up, they expect it to continue to go up. In other words, most investors have no method for anticipating a turn. By contrast, the Elliott Wave model does. The September Elliott Wave theorist provides insight with this graph and commentary. The chart depicts the fractal movements of the stock market as described by an idealized version of the Elliott Wave model. The arrows show how conventional futurists approach forecasting. Because they project trends linearly, they are most convinced of an old trend's continuation at the very time when waves at several degrees of trend are culminating. That's not to say that Elliotticians are perfect. Even those who use the Elliott Wave model might make the mistake of looking for too many turns. As the new Elliott Wave theorist also says, being patient while an Elliott Wave plays out can be challenging for a mind bent on looking for evidence of change. But at least Elliotticians are not doomed to miss every turn. They may be early or late, but they are not inevitably, pathologically late in identifying turns, as linear extrapolators are. A recent example of how linear extrapolation almost immediately hurt investors occurred with technology stocks. This is a September 13th headline and subheadline from Bloomberg. Billions in wrong-way bets poured into biggest tech ETF. Biggest tech ETF posted best inflow since February on September 12th. On that one date alone, September 12th, investors put $2.6 billion into the Invesco Trust Series 1 ETF. The very next day, September 13th, the NASDAQ cratered 5.16%. Talk about bad timing. You see, the NASDAQ had rallied for 4 straight days before that big price slide, and many investors thought it was time to jump in and join the party. That's not to say that the Elliott Wave model anticipated a more than 5% drop in the NASDAQ on that very day. However, the Elliott Wave model had anticipated a continuation of the downward trend. Indeed, on Friday, September 9th, our U.S. short-term update stated the NASDAQ 100 rally should be complete or nearly so. That analysis was provided just 2 trading days before that big one-day decline in the NASDAQ. No analytical method can provide a guarantee. However, in our view, the Elliott Wave model is far better than linearly extrapolating trends. Learn what the Elliott Wave model is suggesting is next for U.S. stocks, bonds, gold, silver, the U.S. dollar, and more by following the link below this video.